welcome to the Deep Dive. Today we're getting into something really relevant for a lot of folks.
Yeah,
Borrowing from your 401k.
that's right.
It's, that big retirement account. Sometimes life happens and you wonder, can I tap into that early?
Exactly.
So our goal today is pretty simple. Cut through the noise, give you the essential stuff you need to know.
Precisely. We're here to unpack the rules, the limits, and maybe most importantly, the real trade-offs involved.
Okay.
Because, yes, it's often possible, but understanding what it really means for your financial future, that's crucial. We want to make it clear, professional, but easy to grasp.
All right, let's jump right in then. The absolute first question I think everyone has is, can you actually do this? Take a loan from your 401k. Is that generally allowed?
Yeah, the short answer is yes. In many cases, borrowing against your 401k is definitely possible.
Okay.
But, and this is the absolute non-negotiable first step, you have to check your specific plan's rules.
Ah, right. It's not automatic.
Not at all. Most employer plans do allow it, but some don't, period. So you need that plan document, HR usually has it, or your plan administrator online.
And if it says no?
Then that door's closed. You gotta look at other options. Simple as that. It really depends on the fine print of your specific plan.
Got it. So step one, check the plan rules.
Sure.
Assuming the plan says yes, you can borrow. Well, how much are we talking about? I assume there are limits, right?
Yeah.
It's not like you can just empty the whole thing.
Oh, absolutely not. There are strict IRS limits in place. Very clear rules.
Okay, what are they?
It's the lesser of two numbers, either $50,000
Okay, 50,000.
or 50% half of your vested account balance.
Vested balance. That's my contributions, plus the company match I actually get to keep.
Exactly. Your money plus any employer contributions that are officially yours, fully vested. Whichever number, 50K or 50% of vested, is lower, that's your maximum loan amount.
That 50% rule. And maybe we could walk through an example just to make it super clear.
Sure, good idea. Let's say you've got $60,000 vested in your 401k.
Okay, 60,000.
Half of that, 50%, is $30,000. Since $30,000 is less than the $50,000 cap.
You can borrow up to $30,000. Makes sense.
Right. Now, say someone else has like $120,000 vested.
Okay, bigger balance.
Half of that is $60,000. But because of that hard IRS cap,
The $50,000 limit kicks in.
exactly, they can only borrow up to $50,000 even though 50% of their balance is higher. It's always the lower number.
Crystal clear. So you figure out you can borrow, you know the limit, you take the money out, but it's a loan. You got to pay it back, right?
Absolutely. It's definitely not a gift. You're borrowing from your future self.
So how does that work? The repayment.
Well, the standard repayment period is usually up to 5 years. That's the typical time frame.
2 years, okay.
There is an exception, though. If you use the loan specifically to buy your main home, your primary residence.
Right, like for a down payment.
Exactly. Plans may allow a much longer repayment term for that, sometimes 15, maybe even 30 years. Depends on the plan again.
And how do the payments actually happen? Do you have to remember to send a check?
Usually, no. The most common way, and it's pretty convenient, is through automatic payroll deductions.
So it just comes right out of your paycheck?
Yep, before you even see it, which, ensures it gets paid, but also might make it easy to forget about the loan's impact.
Okay, and what about interest? I mean, it's a loan, there's usually interest.
There is. Typically, the rate is set at the prime rate plus about 1%.
Prime plus 1. And prime rate. That changes, right?
It does. It moves based on what the Federal Reserve does, generally. So it's not necessarily fixed for the whole 5 years.
And where does that interest actually go? Back to the plan provider?
This is the interesting part. It actually goes directly back into your own 401k account.
Really? So I'm paying interest to myself?
In effect, yes. You're paying your future self interest on the money you borrowed.
Huh. That sounds almost good. Like you're boosting your own savings.
Well, it sounds okay on the surface, but this leads directly into one of the biggest hidden drawbacks, that double taxation issue.
Right. I've heard about this.
Okay.
Explain that, because it sounds kind of tricky.
It is, and it's really important to see, you make those loan repayments, both the principal and that interest you're paying yourself, using after-tax dollars.
After tax.
Yeah.
Meaning money from my paycheck that's already had income tax taken out.
Precisely. Your regular contributions usually go in pre-tax, right? That's a key benefit.
Yeah.
But these loan repayments are after-tax. So, fast forward to retirement. When you eventually withdraw that money, including the principal and interest you paid back,
It gets taxed again.
Yes,
as
sir.
regular income.
Bingo. You're taxed on money that was already taxed once when you earned it to make the repayment. That's the double taxation. It basically eats away at the tax advantage the 401k is supposed to give you.
Wow, okay. That definitely dims the appeal a bit.
It's a significant factor, for sure.
So this is leading us towards the risks, isn't it? It sounds kind of neat, upfront access funds, pay yourself back interest, but there are some serious potential downsides we need to cover.
Absolutely crucial. This is where you need to be really careful. There are major risks involved.
What's the biggest one people should worry about?
Hands down, the biggest danger is what happens if you lose or leave your job.
Okay. Why is that such a big deal?
Because if you leave your employer, whether you quit, get fired, laid off, whatever the reason, you typically have to repay the entire outstanding loan balance very, very quickly.
How quickly?
Often within 60 to 90 days. Sometimes until the tax filing deadline for that year, but it's a short window regardless.
Wow, okay. 60 to 90 days to potentially come up with, tens of thousands of dollars.
Exactly. And think about it, you might have just lost your income source.
Right. So what happens if you can't repay it in time?
If you can't meet that deadline, the IRS treats the entire remaining loan balance as a taxable distribution, like you just withdrew the money early.
Oh no. So you owe income tax on that whole amount?
Yes. And if you're under age 59 and a half, you'll likely get hit with an additional 10% early withdrawal penalty on top of the income tax.
Ouch. So lose your job and get a massive tax bill plus a penalty. That could be absolutely devastating.
It can be financially crippling for people. It's probably the single biggest risk to consider.
That's a huge red flag. What other risks are there? You mentioned downsides, plural.
Another major one is the lost investment growth. This one's a bit sneakier because you don't see it immediately.
How does that work?
Well, when you take, say, $30,000 out as a loan, that $30,000 is no longer invested in the market, it's just out.
Right, it's cash you're using.
Exactly. So for the entire time that loan is outstanding, could be 5 years, that money isn't participating in any potential market gains, if the stock market does well during that time.
You miss out on all that growth.
Completely.
Yeah.
You miss the compounding effect. Over 5 years, that could easily be thousands, even tens of thousands of dollars in growth that you simply don't get. It's money that could have been working for your retirement, but wasn't.
That's the opportunity cost, basically.
Precisely, the silent cost. And then, of course, just to reinforce it, there's that double taxation on the interest we already talked about. It's a direct hit to your overall return.
Okay, so job loss danger, lost growth, double taxation.
Yeah.
Given all that, it sounds like this shouldn't be the first place people turn when they need money, right?
Absolutely. I mean, it really should be viewed as a last resort, not a first choice.
So what are some alternatives people should explore first?
Well, there are several options depending on your situation. Traditional personal loans from a bank or credit union.
Okay.
If you're a homeowner, maybe a home equity loan or a HELOC, a home equity line of credit. Those often have lower interest rates, but remember, your house is the collateral.
Right, that's a risk too.
It is. For smaller, short-term needs, maybe even a 0% APR promotional credit card could work, and this is a big but, you have to be disciplined and pay it off before that promo period ends, or the interest rates can be brutal.
So the main message is, look elsewhere first. Protect that retirement fund if you can.
That's generally the best advice. Every dollar you take out now is a dollar plus potentially decades of growth you won't have later.
You mentioned the lost growth being a sort of hidden cost. Can we put some numbers on that? Like walk through that example scenario you mentioned earlier. I think seeing the dollars makes it really hit home.
Yeah, let's do that. It really highlights the true cost. So remember our example, $80,000 vested balance, taking a $30,000 loan.
Okay, 30,000 loan.
Let's say the interest rate is 7%, prime plus 1, and you repay over 5 years. We calculated the monthly payment is around $594.
Right.
Over those 5 years, you pay back about $35,640 in total. That includes the $30,000 principal plus roughly $5,640 in interest that goes back into your account.
Okay, so you paid it back plus interest to yourself. Seems okay so far.
Yeah.
Where's the hidden cost again?
The hidden cost is what that $30,000 could have been doing if it had stayed invested. Let's say, hypothetically, the market returns an average of 7% per year during those 5 years.
Okay, reasonable assumption.
If that $30,000 had stayed in your 401k and earned that 7% annual return, compounded over 5 years, it could have grown by roughly $12,000.
$12,000 just in growth.
Approximately, yes. That $12,000 in potential growth that you didn't get because the money was out of the market, that is the real cost, the opportunity cost of the loan. It's significantly more than the interest you paid back to yourself.
And that $12,000, if it stayed invested for another 15, 20 years until retirement.
It could easily become $30,000, $40,000, maybe more, depending on returns. It has a real long-term impact on your final retirement number.
Wow. Okay, that really puts it into perspective. It's not just about the immediate loan terms.
Not at all. It's about the long game.
So let's just recap the main takeaways here. Borrowing from your 401k, yes, it's an option, but wow, it comes with some heavy strings attached.
Definitely.
You absolutely have to know your plan's rules, understand the repayment terms, especially that 5-year deadline, and really, really weigh those big risks. The job loss trigger, the lost investment growth, and that double taxation issue.
Couldn't have said it better.
Preserving those retirement funds, letting them grow untouched if possible, seems like it should be the default priority.
It generally should be. Look, understanding all these pieces, the good, the bad, the ugly, empowers you. You can make an informed choice.
Right.
And sometimes, maybe for a true emergency, if you have stable employment and literally no other reasonable borrowing options, maybe is the least bad choice.
A true last resort.
Our true last resort, exactly.
Yeah.
But you have to go in with your eyes wide open, fully understanding that immediate fix versus the potential long-term cost to your retirement. It's a serious calculation.
Well, this has been incredibly insightful. Thank you.
My pleasure.
All the best. And we will meet again with another important subject in the next meeting.